Hello, I'm Howard Green. So you're sitting at home wondering what to do with that cash you've been hoarding. Should you jump in after listening to all those portfolio managers who say you're missing out on nice plump dividends from blue chip stocks rather than getting virtually nothing on cash? Or should you disregard those fee seekers, clutching your loot like there's no tomorrow and maybe hide it under the bed? Sure, stocks might be up today, but you keep hearing about all those big companies that continue to sit on billions or trillions in cash. If it's good enough for them, why not for you? Today's show is about cash. Is it a misunderstood asset? When should you hold it? When shouldn't you? Or should you always have some sitting around? Joining us for this discussion are three money managers you know well. Ross Healy, Chairman and CEO of Strategic Analysis Corp. Barry Schwartz, VP and Portfolio Manager at Baskin Financial Services. And David Burrows, President of Barometer Capital Management. Welcome to all three of you guys. Thanks for coming in today. And I guess let me start with you first of all, Ross, and let me pose the question I posed in the intro.
Sure.
All that cash sitting on the balance sheets of all those companies, they're not spending it, they're not investing it, so why should the retail investor?
Well, I mean, first of all, that's a really excellent question. If they can't find anything to invest in, then the real question is, why should we invest in them? Michael Lewis, who wrote Moneyball, had a great quote this morning, and he said, just because that you've got a house, a beautiful house with no mortgage in it, if you're in a declining neighborhood, it may not necessarily be cheap. And I would agree with that. I think you've got to be cautious about what you invest in.
Barry? Same question.
Businesses are sitting on cash. Consumers are saving. Governments are in austerity mode, so no one's spending money. But what are we waiting for? Are we waiting for the outlook to get better? If you wait for the outlook to get better, things won't be so cheap anymore. Look what's happening past couple days, even today. Market's feeling better. Think we're going to come to some type of resolution. Stocks are going higher. So if you're sitting on your hands, you are going to miss out. And businesses can miss out.
But you don't really know what kind of resolution, quote unquote, you might get from Europe, if you're talking about Europe. I mean, there are so many unknowns.
No, there's so many unknowns, but what we do have is we have knowns. We know that the market is cheap on forward earnings for 2011. We know that cash on balance sheets is good. We know that dividends are rising. We know that dividends are better than what T-bills are paying. So those are the knowns. That's all we can play in. If you invest in unknowns, you'll never invest.
Okay, so we got two sides of the coin. You get to be the third side of the coin. Lucky you.
Look, Howard, you've heard me say this before. This is all about picking your spots. There are times to be fully invested, and there is time to have cash. The unfortunate thing is when everybody comes to the conclusion that cash is the place to be, it generally sets up an opportunity, which I think we saw at the beginning of last week. But that being said, you have to be there relatively early. There are times to be right out of big parts of the market, and there's times to sit on your hands, because at the end of the day, cash does provide you an opportunity when the time comes.
What about what Ross said, that if you've got a nice house but you're in a declining neighborhood, you're not going to be protected?
I couldn't agree with him more. I mean, at the end of the day, 80% of return in an investment portfolio comes at the hands of the asset class you're focused on, should you be invested or not. And second, the sectors you're either focused on or not in. About 20% of return is specifically just business characteristics of the companies that you own. So you have to own things in parts of the market people care about now, and if there's money getting put to work, great, there's money coming in behind you. You just don't want to fight the tide in a difficult market, and there's times not to fight it.
Ross, I want to come back to you on something Barry said, that stocks look cheap.
I'm going to disagree violently with Barry, not just loudly, but
verbally violently.
Verbally violently. That's right. Stocks are not cheap, and certainly not historically cheap. If we, for instance, take a look at the Dow Jones Industrial Average, trading about twice book. Okay, in the last 90 years, the Dow has only traded above twice book twice. One was in 1929, and the other was sort of in that last thing that we've had, that sort of explosive tech-led bull market, rather, which kind of came unglued. But if you exclude those two, then the Dow is quite expensive. And if you take the Dow as a kind of a proxy for high-quality stocks, high-quality international whatever stocks, which I think you can, then I would come to the conclusion that you've got to be very careful. There are cheap areas of the market, but largely speaking, I just don't see the deep intrinsic values.
Barry?
I think stocks are cheap, and I'll tell you my reasons why. Now, certainly there's sectors that are overbought, no question. People have rushed to the utilities, the consumer staples. They may be expensive, but there are certain sectors that are very, very cheap. Commodity names have been sold off dramatically. But let's look at where the S&P is. The S&P is trading at 1,200, and I think it's a better barometer than the Dow. And we got earnings that are going to be 95, 100 this year. Every time we go into a recession, S&P is trading at 14, 15 times earnings. Not this time, it's trading at 12 times earnings. Last week it was trading 11 times earnings. I think you have to discount the environment we're in where bonds and interest rates are paying you nothing. Shouldn't that be even better for stocks and dividend-paying companies?
But you know, I want to come back to the thesis of this program and cash versus other things.
Yep.
And I want to raise one example and get you guys to discuss it. A lot of people looking for yield went into a stock like Yellow Pages for that yield. And they would have been a heck of a lot better off in cash. So you can think something is stable, yada, 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 but you know, if the stock price tanks, your yield's worthless, we've seen, and you would have been better off in cash, maybe even taking a bit of a hit on inflation.
Let me jump in on this one. At the end of the day, the way you make money investing is you buy things that people are prepared to come in after you and pay higher prices. And so ultimately, our belief is the market is a great synthesizer. All of the information goes in at various points in time, and behavior comes out. So valuation is a little bit of a difficult discussion because there's a lot of moving parts that go into saying what is cheap relative to interest rates in the current economic environment, all those things. We tend to look at market behavior to say, is breadth in the market expanding? In other words, over time, are more and more securities doing better, or are they doing worse?
Is the neighborhood getting better?
Is the neighborhood getting, exactly. So, you know, in the case of Yellow Pages, whether or not your view was that fundamentally it was a sound business, the market was voting with its feet, and it was getting cheaper and cheaper. And you have to take the clue sometimes that maybe you aren't the first one to find out there's a problem.
But a lot of people told investors that it was better than cash for a long time, right?
Clearly, but they were fighting the tape by buying something that's falling in price. So ultimately, I like to see market behavior that supports my view. I may believe that I see fundamental characteristics that point to something getting better, but if the price behavior is going the other way, it's very possible you're missing something. So I think it's important to understand what the market can tell you along with your own personal views.
Yeah.
Sorry, Ross.
I was going to say, what Barry and I both talked about are two different ways of looking at value. I tend to look at book value and the quality of book. Barry looks at price-earnings ratios, and both of those are perfectly valid. The problem with price-earnings ratios, however, as I've seen in my long career in the business, which I will not tell you how long, but nonetheless, I remember quite a few years ago when price-earnings ratios got down to as low as 5 and 6. In that kind of a case, 15 times earnings doesn't ring any bells with me. Whereas if we look at book values, their highs and lows tend to be rather more stable. And lows for the market tend to be in around book or a slight discount to book.
I.e. the replacement value of the assets.
The replacement value of the assets. And on that basis, even the S&P, although it is cheaper, I will certainly admit, than the Dow by quite a bit, still isn't what I would call kind of a bargain.
But having said that, wouldn't that have meant you'd spend most of your career sitting on the sidelines? Because very few times have you been sitting with the market trading at book value.
And what about the financials?
And there have been plenty of very good opportunities along the way.
Well, I mean, there's a range of book values. When things get up to the top or at the high end of things, which the Dow is at the present time, that's when we get worried. And when we see the market sort of start to weaken and break those kinds of values, then that's when we get nervous, and that's when we tend to move to cash, which we have.
It's interesting because one of the things that we track, as I mentioned, this breadth indicator, and we know that when 70–80% of stocks in the market are in positive long-term price trends, it's getting well owned. Probably things aren't inexpensive, and when we start to see that percentage decline, it probably means there's not enough money going into the market, enough money coming out where risk rewards change. Now, if I look at current market, we recently went to the point where only 18% of stocks in the NYSE were in long-term price trends, which is within a whisper of where we were at the lows, not in March of 2009, but in fact, November of 2008, which was sort of the internal lows in the market. So all I'm saying is there are times when sentiment gets so overdone to the downside that you can set up what can be a very significant, at least retracement rally that is opportunity.
Sorry, guys, I just got a break to sell some soap. We'll come back. We'll be right back after this.
What makes